Hey, how's it going? Bill Lethman here for Money Evolution. In this video, I'm going to be talking about Roth conversion math, or really what is the most important factor that you should be thinking about if you're considering doing a Roth conversion. And this is a question that comes up all the time. And a lot of times people ask me different things like, does it matter what rate of return that I earn on my portfolio? Is that going to have a difference or an impact on whether I should do a Roth conversion or not? Or does it matter how long I leave the money invested? Does that have an impact? And what I'm going to share with you in this video is just a really simple example of why none of that really matters. And the most important factor really is, what is your tax bracket today versus what do you think your tax bracket is going to be in the future? And essentially, if you think you're going to be in a higher tax bracket in the future than you are today, then it's probably going to make sense for you to do that Roth conversion. And that's what we're going to illustrate here. There is one other factor that you need to be thinking about that I'm going to talk about later in the video. And it's something that I think really gets overlooked. And that is understanding where and how to pay the taxes on the Roth conversion and the impact that can have on the decision as well. So we're going to talk about that a little bit later here. So let's run through this really quickly. And let's say that you have $10,000 in a traditional IRA account and you're thinking about doing a Roth conversion. So the first thing we need to talk about is what could that account grow to over time? Well, we're not going to in this video get into rates of return and things like that, but we're going to assume that this account is going to double over some period of time. And honestly, it doesn't really matter what period of time, whether that's 5 years or 10 years or 15 years, but we're going to assume that that account is going to grow from $10,000 to $20,000. And let's say down the road, whether that's 10 years or 15 years down the road, that account doubles and you decide to cash that account out. And if we assume that today you're in a 30% tax bracket, let's say that's state and federal combined, however you want to look at that, we're just going to make our math here relatively easy here. And we're going to assume that you're in the same 30% tax bracket in retirement. So if we applied a 30% tax rate to $20,000, that would be $6,000 in taxes. That would mean that if you cash that account out, you would net $14,000. Now, let's say, hey, we're going to do a Roth conversion. Okay, we're going to assume everything else is going to be the same. And for, again, simplicity here, just to illustrate this point, we're going to assume that you're going to pay the taxes on the Roth conversion out of the IRA account itself. This is something I just did a video on here very recently. And one thing you definitely have to keep in mind if you're planning on doing that is that you're over 59 and a half. So if you try to do this and you're not yet at that full retirement age or the 59 and a half for normal distributions, you're going to get hit with a 10% early withdrawal penalty. But we're going to assume that you are over 59 and a half and you're going to pay 30% tax at the time of conversion. So that means that instead of basically having a Roth IRA account that's worth $10,000 or a traditional retirement account that's worth $10,000, you're going to have a Roth retirement account that's worth $7,000. We're going to assume that you invest that exactly the same way as you did over here, and we're going to assume that that account is going to double over the same period of time. In this case, we're going to double $7,000 and it's going to double to $14,000. And again, what we're assuming is that your tax bracket here is 30% today, and it's also going to be 30% in the future. So what do we notice here right off the bat? Well, as long as our tax rate stays the same, there's no difference between keeping that money in a traditional account or moving that money over to a Roth through a Roth conversion. This would also be exactly the same math if you were thinking about maybe not a conversion, but you were thinking about, should I contribute to a traditional 401k plan, let's say, or should I contribute to a Roth 401k plan as an example there? So as long as our tax rate stays the same, there's really not going to be any difference in that. So I did mention there's going to be one other factor that's going to come in here, and that is how you pay the taxes on this. So here we're assuming that you're taking the taxes right out of the conversion itself, but let's say that right at the time you were thinking about doing this Roth conversion, $3,000 fell out of the sky. You just came into $3,000, or maybe you already have it somewhere else. But we're going to keep it really simple here. We're going to say you have $3,000 in, let's say we're going to call it a non-retirement account bucket here. We're going to assume it's in cash. You don't have to sell anything. There won't be any capital gains to liquidate that or anything. But you're going to have this $3,000. And so what's going to change is you'll be able to use that $3,000 to pay the taxes on the Roth IRA account. So instead of having a $7,000 account, you're going to have a $10,000 account. And for some reason, the size of my pen just changed in the middle of the video, but that's okay. So you have $10,000, and that is going to grow to $20,000, the same as the IRA. The difference is that there are no taxes on this, so you'd be able to liquidate that. So right off the bat, that seems like a pretty good deal, okay? But if we don't do the Roth conversion, you're going to be able to allow that $3,000 to grow. We're going to assume that that grows as well. So we're going to assume that that grows from $3,000 to $6,000. And we're going to assume that you put it in something that's going to get some long-term capital gains tax treatment. Normally, for most people watching the video, it's probably going to be a 15% tax. And let's just say we got some state taxes in there, and just again, make our math relatively easy. Let's say that you have 20% tax. Now, you're paying taxes not on the full $6,000, but you're only paying taxes on the $3,000, which is the growth part of that, which means that you would actually have $600 in tax to pay, and you would end up with $5,400. So if we come over here, add $5,400 to $14,000, we have $19,400 is the amount that we have net after we cashed out both accounts, that non-retirement account plus the regular IRA account after paying taxes. So now here we are in exactly the same situation where you have a 30% tax bracket, and that is not changing for the IRA portions of these accounts, but you end up with a little bit more money still by doing that Roth conversion, and that's because of the tax over here on the non-retirement account bucket. So, so again, if your tax bracket is even going to stay the same, as long as you can pay the taxes with something other than taking it out of the IRA account, then it's probably going to make sense for you still to do that Roth IRA. Now, when does it not make sense to do a Roth conversion? Well, it doesn't make sense if you are, let's say today, at a 32% tax bracket, but in retirement, you think that's only going to be a 28%. That's going to be math that's going to favor you taking some tax deductions now, maybe contributing to those traditional 401k plans, and maybe not doing those Roth conversions because we don't want to pay more taxes at 32% when we know, or at least we're projecting in the future, that we're going to be in a 28% tax bracket. Another question that comes up a lot, in fact, it was actually asked here when we were going through some of the content that we're working on today for this video in the office. And it was a younger guy, Bobby, in my office, and he said, well, I'm young, I've got a lot of time. He goes, I may double, obviously, hopefully more than once. He's in his early 20s. Hopefully he doubles a few times over his lifetime. So what happens in that situation? If we doubled from 10,000 to 20,000, we went up here and we doubled to 40,000. We're going to pay the 30% tax on that, so that's going to be $12,000 in tax, and we're going to have $28,000 left. Going back to our earlier example here, if we double that 14,000 again, what does that equal? 28,000. So there's no difference there, once again, between the two different accounts as long as the tax rate stays the same. So I know the math got a little bit into the weeds, maybe a little bit more than I wanted to here, but hopefully that gives you a pretty good idea of just some of the things that you should be thinking about if you're considering doing these Roth conversions. It really does all come down to what is your tax rate today versus what is your tax rate in the future. A couple more things about that real quickly. We currently have the Tax Cuts and Jobs Act rates, which are set to expire at the end of 2025. So we have 2024 and 2025 with these lower tax rates. That's pretty much across the board for all tax filing statuses, and really all brackets pretty much have a lower tax rate today than at least what they're projected to be out into the future there. So that's one positive reason for doing a Roth conversion. But again, you want to be looking at things too, not just in terms of, hey, the overall tax rates are going up, but again, what is your personal situation going to look like going out into the future? So if you're, like I said, in a big high tax bracket today, but you may be retired in a few years, you got to look at what is that tax bracket projected to be. So one of the things that we do with our clients, we do it both through our comprehensive financial plan that we call the Money Evolution Plan, but it's also available in some great reports that we have inside the Retirement Time Machine, which is our DIY retirement planning program that we have for people. And there's some great reports in there that really kind of lay it out, looking forward into the future. What are those tax brackets likely to be, or what could they be based on some assumptions? And those assumptions are a couple of things. One, the reversion back to the old tax tables starting in 2026, because that's all we really know right now. So we'll have those old tax tables reapplied with some inflation adjustments there. So it gives you a really nice forward look at just what that is. But the other factors that are going to go into this are going to be, how your money is distributed, how much money you have in those different retirement buckets. We talk about the non-retirement account bucket, the traditional, and the Roth. And so you can see, as you start to map out your cash flow, what that looks like as you go into retirement and how you're going to be distributing money from each of those buckets. Generally, for most people, it's going to make sense to take money out of these non-retirement account assets first. There may be things like capital gains. There may be interest income. Those gains could be short-term or long-term. And you could also have some dividend income. And there's a couple different ways that those assets or those investments are taxed. Traditional retirement accounts, everything basically coming out of that is going to be taxed at the ordinary income tax rate or your tax table. And of course, the Roth is going to be tax-free. So as you start to map this out, you're going to be able to see with the cash flow needs that you have, how much money you need just to support your retirement lifestyle and everything, what those distributions are. And then again, if you have most of your money in a traditional retirement account, you got this big bucket and you need a huge amount of money every year to live off of, all that money coming out is going to have a high tax, or you're going to be taxed at your ordinary income tax rate. And so understanding what those distributions are and how that could push you up into a tax bracket is going to be something very important to understand. So again, we get into those details in those programs. If you want to learn more about that, we've got some links down in the description below. You can check that out. And yeah, look forward to seeing you back in one of our next videos. Thanks.